Hey everyone, Koch Investor back to another video for today. I know it's a bit later than usual. Came back from Oppenheimer, then had to listen a bit to the earnings call from Pinterest. By the way, Oppenheimer, great movie. Pinterest, it's still in my portfolio for one reason or another, but I don't know for how long. I still hold it. I don't know when I'm gonna sell it. Still have to re-listen to the whole earnings call, but to be honest, I was expecting more. We had a double beat, fine. Users are growing, fine. Guidance, as you will see, is also okay, not wow. They expect EBITDA margin expansion as well and full effect of the Amazon Ads partnership to take full effect in 2024. But still, I was expecting more, especially watching and reading about how well the others have been doing, right? The other ad players, the other social media players, besides Snapchat. You can see a reacceleration, right? Especially when it comes to profitability, but also revenue. When it came to Pinterest, I was left disappointed, to be honest. I think this is the main word I'll use throughout this report, disappointed. And I think the market agrees with me, although after hours it was a roller coaster ride, but currently at the time of making this video after the earnings call, stock is still down 3%. Of course, it can be bought up tomorrow if the whole market is green, but I think the market has been left disappointed. So let's get right into this. So first a comment from the CEO, which I think has done a much better job than the previous one. So he says here, in Q2, we continued to build momentum with consumers and advertisers while further accelerating our pace of innovation. Over the past year, we've been laser focused on our key differentiators and we're seeing results. Users are coming back more often and engaging more deeply. Pinterest is increasingly shoppable and actionable, and we're delivering better and more measurable performance for our advertisers. Furthermore, due to our focus on cost efficiencies, we returned to adjusted EBITDA margin expansion in Q2. Our results demonstrate that our strategy is working and we're making the right investments to create a durable company for the long term. And I agree. We've talked about shoppable pins for a long time, right? I think 3 years ago or something like that. Finally, we are seeing some momentum there. But again, I was expecting more. Now, another problem here is that revenue did not outgrow total cost and expenses. Not only that, if you look at stock-based compensation, that increased quite a lot year over year. Not only that, they used all of the $500 million for the share buyback program. And guess what? We have more shares today than we had last year. So you start to see my disappointment here. Now, when it comes to guidance, it becomes a bit better, but still. We currently expect Q3 revenue to grow in the high single digits range year over year. Expect our Q3 non-GAAP operating expenses to grow in the low single digit range year over year. Okay, better than this quarter at least. So now let's dive into the report highlights here. So Gen Z users continue to grow on Pinterest, that's great. In Q2, Gen Z were our largest contributor to overall engagement growth and the fastest growing cohort, growing double digits and accounting for a larger portion of our overall mix. When it comes to the shopping experience, users are actively engaging with shoppable content, with click-through rate and saves of shoppable pins growing over 50% year over year, accelerating from Q1, and shopping ads revenue continued to grow at a pace meaningfully faster than the overall revenue rate. Of course, Pinterest being a very special platform because you go on Pinterest with the intention to buy, to do something, whether it's in your life, somebody else, a birthday, wedding, renovation of a room, etc., etc. So you come with the intentions to buy, which already makes this platform way better for advertisers. Now, of course, with the help of AI, you can basically look at what certain people connect different products, right? You're buying these shoes with this dress, with this bag, etc., etc. And so you can make recommendations for other people based on those selections, which is pretty special and I think very, very useful for advertisers. So yes, again, there is potential. There is very, very big potential here. The problem is I specifically am holding already 3 years and I am waiting to see the big potential here. So let's continue. Revenue. Globally, it increased 6% year over year. US and Canada up 4%, Europe up 12%, and rest of the world up 32%. Of course, you know, ARPU rest of the world, very, very insignificant as of today. Then when it comes to monthly active users, we continue to grow there. So 8% growth year over year, 3% in US and Canada, 6% in Europe, and then 10% for the rest of the world. When we look at ARPU, globally it's down 1%. In the US and Canada, it's up 2%, Europe 6%, rest of the world 20%. And like I said, rest of the world pretty insignificant, just 12 cents there. Now, this here again, I was expecting, since advertising, we've seen this with Meta, Google, Roku, right? Advertising market there, especially for those companies, much better than what we were expecting. So seeing that here globally it is down 1% is a bit of a letdown. So yeah, we'll continue. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Then non-GAAP costs and expenses. So cost of revenue is up 1% year over year, 23% of revenue. R&D is also 23% of revenue. That's up 5% year over year. Sales and marketing is up 13%. I mean, everybody is cutting costs here, and they keep increasing here. And not only is it up 13% year over year, it's now also 31% of revenue, which previously was just 30%. Okay, I'm picking here little details, but still to paint the largest picture here. Then G&A, that's down 15% year over year. It's now 9% of revenue. When you look at adjusted EBITDA, yes, this has improved quite nicely. Up 16% year over year, adjusted EBITDA margin of 15%, and we reached adjusted EBITDA of $107 million. And like I said at the start of this video, second half of the year and going into 2024, expect expansion when it comes to EBITDA margin and EBITDA itself. Is great. They show operating leverage, but again, especially in the current market, the current situation, stock market, just companies overall, you do start to think about, are there better opportunities out there? And that's exactly my conundrum or something like that. I don't know if that's even, yeah, maybe that's the word. I'm debating whether or not I should just sell it and buy something else that is more attractive today. Again, I have to think about this. This is quick reaction that I wanted to put out on YouTube, pretty raw. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.